Folks, thanks for coming to You May Be Insured, but Are You Really Protected? My name is Michael Conroy. I'm an attorney here in town with Hassett and George. We've got an office right down the street, and we have another one in Glastonbury. I'm a litigator. All I do is civil litigation. Probably 90% of the cases that I've handled over 24 years have involved insurance coverage in some fashion. Before I went to law school, I was a claim representative for an insurance company, handling a bunch of different things. So this is kind of what I do on the claims side and the coverage side.
Yep. Again, thanks so much for coming. Craig Kubasek. I'm an insurance agent right across the street here at Kerr Agency. And we focus mainly on local personal lines and commercial lines insurance, both from a price standpoint and the coverage standpoint.
So we're going to keep this relatively casual, kind of conversational. We've got a nice small crowd here. If you have any questions, any thoughts come to mind, don't hesitate to ask us. But this talk came about, Craig and I were just kind of talking about trends that we see. You know, everyone has insurance coverage, we hope, but we should all have auto policies. If we have a car, if we own a home of any sort, we're going to have a homeowner's policy. Many people, they have a policy, they think they're covered, but they don't always have the coverage that they need. And we got to talking, and one thing that I'm sure Craig can fill you in more on, but what I see a lot is when people are shopping for their insurance coverage, they're shopping for price. Am I right?
Yeah.
And insurance coverage is not necessarily something you want to skimp on. And I see the after effect. When something goes wrong, I see a lawsuit. A lawsuit hits my desk. Something went wrong. There's not enough coverage. There's the wrong kind of coverage. Why don't you tell them what you see on your end, Craig?
Yeah, a lot of times a lot of carriers push based on price. 15 minutes will save you 15%, and it confuses, I think, a lot of people when they're buying insurance because they don't really know what they're buying. So to have a better understanding of what your limits actually cover and how you are protected from those limits is really important. Most of my job is educating our clients on what they're actually purchasing. A lot of people will say, oh, well, I have full coverage, for example. It gets tossed around a lot. And in reality, full coverage doesn't really mean anything. You may have comp and collision deductibles on your autos, so there technically is some coverage, but a lot of times those are minimal limits, which in a claim situation you can run through those pretty quick.
That can be a disaster. Yeah. And I think in your business, Craig, because so many people are price conscious and they shop price first, probably a lot of your competitors are looking to give them that price they want, right? And what you want as a consumer is an agent who is going to take that extra step and educate you as to what the different coverages are and how much coverage you should probably have, and some of the nuances of coverage that we're going to get into a little bit. But what we thought we'd do tonight is take you through the basics of auto insurance and then the basics of homeowners insurance with a couple of little extras thrown in. But like I said, if you have any questions, feel free to speak up, okay? All right. Auto Insurance 101. There's some basic components to any standard auto insurance policy. The first one that I always want to talk about is liability coverage, because that's a large part of where I get involved in. There's a car accident, somebody's claiming injuries, and I represent actually plaintiffs and defendants in those cases. So I'm dealing with that stuff literally every day. Now, who here has an auto policy? Everyone, I hope? Okay. There are limits to the different types of coverage, and we can go to the declarations page right now. If you look at your declarations page of your auto policy, that's going to tell you what coverages you have and what the different limits are. And we'll talk about why those numbers are important.
Yeah.
Craig?
So right here, what I grabbed is just every auto policy that is ever sold will have the first few pages of the policy are what they call the declarations page. And it's a very brief overview of what's covered in that policy. For example, here, there are 3 vehicles, and if you can see right here, single limit liability, so $500,000 is single limit. If you remember from the last slide, it said 2550 is the state minimum limits.
Right there.
I think it was 1965 or 1970 when the state set minimum limits at 1020. So in 50 years, they've gone up very small, pretty small amount. So what this means is you have 25,000 per person, 50,000 per accident in liability coverage. So if you go to that next slide,
Sure.
If you see here, this is 500,000 per accident, all in. So obviously it's a huge difference. And if you see here, this is just vehicle 1. So on this part of the policy, it's showing what each of these coverages is actually costing per car. So that 500,000 of liability is costing $400 a year on this vehicle. So a lot of times you'll say, if you have lowered limits, it's not a huge savings to increase. It's not a huge jump when you increase those limits significantly.
Now, Craig, what I've found, and you deal with this all day, every day, so correct me if I'm wrong, is that the higher you go up in terms of coverage, it's kind of it's a downward scale in terms of the cost. So the higher the amount of coverage, the less it costs.
Yeah,
right, generally.
It's not proportionate to if you have 300,000 versus 500,000. It's not going to be 2/3 more expensive. It does decrease as you increase your coverage.
And one thing, while we're talking about these numbers, I just wanted to point out, does the pointer show up? No, it doesn't. This minimum limits of $2,550, as Craig said, that's per person and per accident. That's the statutory minimum required to drive legally in Connecticut. $25,000 per person. I can tell you, if you're in an accident and somebody actually gets hurt, $25,000 is gone like that. Like that. And one thing that we're going to talk about, time permitting, a little bit is umbrella coverage, personal excess liability coverage. I think it's a good idea for anybody with a house, a job, and assets to protect, but we'll get into that. If you just have a minimum limits policy and you're in an accident, that type of coverage will be exhausted very quickly, and you cannot get, correct me if I'm wrong, Craig, an umbrella policy on top of a minimum limits policy.
No.
I don't think there's a carrier in existence that will write an umbrella policy unless the underlying policy is at least a 100, 300, or is it more?
Yeah, that's the minimum for every. So at Kerr Agency, we have about 25 personal lines carriers that we write with, and of all of those, the bare minimum for an umbrella would be 100, 300.
Right. Because I can tell you, just from having handled these cases, both as an adjuster, as a plaintiff's lawyer, and as a defense lawyer over the past, it's almost 30 years now, but having handled these cases from all those different positions over that time span, I can't tell you how many of them involved injuries that ultimately had a value in excess of 6 figures. I mean, one of the 2 very common injuries that we see in moderate to somewhat severe car accidents are herniated discs, quite often cervical discs, and rotator cuff tears. People are holding the steering wheel and there's this big, so you can understand the mechanics of the injury. In my experience, rotator cuff tears usually end up resolving in the low to mid 100s range. And if someone has a cervical disc herniation that requires a fusion surgery, which is not uncommon, those usually, depending on the circumstances, are valued well into the 200s. So if you have this 25, 50 minimum limits policy, you're in trouble. if you have, I tell everyone that has assets to protect, you have to get at least enough liability coverage on your auto policy to allow you to get an umbrella. Because if you don't have an umbrella, it could be a problem if things go wrong. And for a typical $1 million umbrella, how much generally are people looking at spending?
2.25-ish,
So
right around there. So, like as you're looking here, so $500,000 on this one vehicle is costing $400 a year. You can add $1 million to all of the vehicles plus your home for roughly $225.
Right, so that's an extra layer of $1 million worth of coverage to protect you in the event of a catastrophe for around $200 a year. And that's a lot of peace of mind for a couple $100. Yeah.
You're saying that an umbrella piggybacks on the car insurance, and so both drivers, both spouses would be covered under
Right.
the umbrella policy.
Right,
Is that universal across all umbrellas?
pretty much.
Yeah, as long as they're on the policy, anybody part of your family is going to be covered as long as they're allowed to drive the vehicles. And it also covers the liability on the home too. So it sits over the top of both the home and the auto.
So it's your personal liability as well, aside from driving a car. And it's going to, if you sit around at night reading your insurance policies, as we all do, because it's so much fun, in the definitions section, they will all define what an insured is. And the typical definition, this isn't verbatim, but goes along the lines of whoever is named on the declarations page, plus any resident relatives. So your family that lives in your house with you, if their name is not on the declarations page, it doesn't matter, they're still an insured. And in some circumstances, especially under auto coverage, permissive users become insureds. So you'll loan your car to your buddy or your neighbor, they can become an insured for that limited purpose under your policy. All right?
So, sometimes I've heard of someone who drives some cars.
Right.
Now, she has her own coverage,
Mm-hmm.
her own auto collision and liability.
Yeah.
But if she gets in an accident based on her current coverage, is that an issue, or does her insurance?
Generally speaking, the insurance follows the car, and that will be the primary if there's an incident. So if she's driving your car, it's your policy. All right?
If she's
So
not listed as an insured,
tell her to slow down.
but if she drives and she's not listed as an insured,
Yeah.
She's a permissive user.
Yeah, as long as you gave her permission to drive it,
then it's.
yeah.
Right.
She falls under that.
Okay.
Yep.
Yeah.
Okay.
Talk about relatives, does that include a grandchild or a son-in-law?
If they're a resident relative, it should, yeah. Yeah.
If they're resident, they have to be in the state.
No, if they live in your house.
But if they don't live in the house,
If they don't live in the house and you allow them to use your car, that's a permissive user.
okay.
All right? All good?
Yeah.
Okay.
You want to go right here?
I'm sorry? UM. Okay, so everybody here knows what underinsured motorist coverage is, right? Okay. Uninsured and underinsured motorist coverage is there to protect you in case you are injured in an accident by someone else who either has no insurance or has less liability coverage than you have uninsured motorist coverage. Is that clear? All right, so let's say you get hit. You're minding your own business and somebody rear ends you, and they have no coverage. Your UM coverage will kind of step in and go to bat for them, and is there to compensate you for your injuries. If they have coverage, let's say you get hit by somebody with one of those state minimum policies at $25.50, and let's say you have that $100,000 injury. They only have $25,000 in coverage. Their policy will be exhausted, and then your UIM coverage will kick in after their policy is exhausted. Now, one of the things that Craig and I talked about when we were talking about giving this presentation, pet peeve of mine. What is it?
Conversion.
Who here knows what conversion coverage is? Don't all throw your hands up at once. Believe it or not, we're going to explain it to you. It's a special coverage that you can buy on your auto policy. My personal feeling is that it's insurance agent malpractice not to insist that an agent's clients all buy it, or at least educate all of their clients and explain why they should buy it. Here's why. Under the normal circumstances in a policy that does not have what's called conversion coverage, if you're injured in an accident by, let's go with an uninsured, well, by an underinsured driver. Let's say you have this policy with $500,000 UM, and the other person has, let's say, a decent policy, $100,000 in liability coverage. He's underinsured because he's got that 100 policy, you've got the 500 policy, much bigger. So he's underinsured compared to you. Under the normal circumstances without conversion coverage, those two policies both start at $0, and they run concurrently, okay? So the most you will ever, if you have a catastrophic injury, the most that you can recover is the highest limit in play, which is your $500,000 in UM coverage. But your policy won't kick in until the other person's $100,000 is exhausted. So you'll get 100 from theirs and 400 from yours up to that cap of 500. With conversion coverage, that allows you to take those two policies and stack them on top of each other. So instead of a total of $500,000 available, in that example, there's $600,000 available. And if the coverages are higher, let's say the other person had $300,000 coverage. Instead of still just having that 500 available, you've got 800 available. And what is a typical conversion coverage rider cost?
$20, $25.
Is it on the declaration page?
Yeah, so if you see,
It is on this one.
right here, section C, uninsured with conversion coverage. And this one's actually doubled, so they'll allow you, typically they only allow you to buy the same amount as your liability limit.
Okay.
They will allow you to double it. So for $1 million with conversion on this policy in particular, it's $139 per car. So without conversion, it'd be somewhere in like the 120 range.
Those are annual prices.
Yeah, these are annual.
But in terms of the level of protection and the dollar value of these different a la carte coverages, in my view, and you correct me if I'm wrong, Craig, in my view, conversion coverage is one of the most bang for your buck coverages that you can buy. It's good, like Craig said, it typically costs somewhere around $20 a year. And it gives you that substantial additional layer of protection if you are in an accident, somebody else's fault, and they have inadequate coverage. And when you think about it, just anecdotally, statistically, who's most likely to hit you and hit you hard? Somebody who's probably irresponsible, someone who probably either doesn't have any coverage or has minimal coverage. I mean, to step out of my lawyer role, I myself was in an accident in 2006, and I was hit hard from behind. I had to have back surgery. The guy that hit me didn't have a license, didn't have insurance, and he was driving an unregistered vehicle. Statistically, that's the guy that's most likely to whack you. So you're doing yourself a disservice if you just assume that everybody else out there has the right coverage. And we've all seen the ads on late night TV for I won't name any of the companies, but hop online, get your certificate right here. And you pay your minimal down payment. Well, guess what? How many of those people that sign up for that ever make the second payment? There are a lot of uninsured people out there, and there are a lot of people who they get their minimum limits policy and they figure, I'm good. I'm all set. You've got to protect yourself. Okay. What else we want to cover on auto?
So is there any question to what else is covered on an auto policy? as you can see, these two, this would be your comp and collision, which obviously collision is any moving accident, and other than collision or comp is anything that happens to the vehicle when it's not moving. So a tree falls on it when it's parked or anything like that. And then the one other piece here is the medical payments. So medical payments are usually these small limits. So in this case, it's $5,000. And what that allows is some small funds, typically to try and cover a deductible if somebody is injured, so that there isn't need for a lawsuit to get into something that you're legally liable for. So it's a small amount of coverage so that they don't need to call.
And one other thing that I wanted to touch on is property damage liability. So the revised minimum state limits are $25,000, and they just revised these state limits, what was it, a year or two ago?
If that.
It was ridiculous. It was 2040 since the early 70s, and now it's all the way up to 2550, which is nothing. But the minimum property damage liability limit is $25,000. And does it show what this one is on this policy?
So since this is a combined
big.
single limit, it's
Combined single limit.
500,000. So that includes your property damage.
So that's
yeah.
that's another number to be conscious of when you're shopping for insurance, because the average price of a new car is approaching $40,000 these days. And just look around town. Look at all the Mercedes SUVs and whatever. There are a lot of $50,000, $60,000, $70,000 cars out there. And when most of us hear that a car was totaled in an accident, in our minds we're picturing the obliterated car that you can't even recognize, that you see on the 6 o'clock news, and God, was that even a car? What is that thing? Not so. The way insurance companies, and step in if I'm wrong here, Craig, the way insurance companies total cars is it's a calculation, and they take into consideration the repair cost, and if you haven't had a car repaired recently, they're up there, especially when you get into body work, and if there's any frame damage from a collision, the car's done. I have a good buddy who, his teenage son just introduced his 3-week-old BMW to a tree. Frame damage, $40,000 car, bye-bye. Okay?
Yeah.
So if you've got a $25,000 limit on your property damage liability, and you have the misfortune of skidding, or you spill your coffee on your lap or whatever, and you hit one of those cars and you damage it badly, well, your policy will pay out that $25,000, but then the other 15 or 20, that's on you. So it's something to be aware of.
And it doesn't take into account if there's multiple cars in an accident. So it doesn't
Right.
even necessarily need to be a severe accident to get to that 25. I mean, accidents get expensive very quickly, especially, now with new cars, with the technology that's in them, and the cost to repair them is significantly higher than it used to be.
And that's just talking about cars. There was a story on the local news just this weekend. Somebody decided to introduce their car to a restaurant in Glastonbury. And I saw the picture on the news, and I just was at that restaurant about a month ago. Car is impaled in the front of the restaurant. I think that 25 grand just went out the window pretty quickly.
So how do you mitigate that or protect against it? Or how do
You talk to your agent about what your limits are, and you get quotes on increasing the limits. All of this costs money, but being careful and protecting yourself always does.
And to go back to just a quick note on the totaling thing. So typically, if it's over 55% of the current value of the car, they're going to total it. So if your car's worth 20 and they're at 11 to repair it, it's going to be totaled and they're going to pay out the 20. So it'll
And
get
especially,
very quick.
if it's a late model or more valuable car, the insurance companies actually like to total those because they have higher salvage value. So they can, when they total those cars, they take the car and they sell off the parts. And if it's a valuable car, they can get more money for the parts. Their bottom line is better. All right, anything more on this?
Before we go on to the home, are there any questions? Anything that's come up that's
If you're
Yeah.
using the little safe driving units in your car with the app on your phone,
Yep.
does that offer any discount towards the umbrella policies also?
No. No, those will, so the companies that we work with that use them, and I don't know, do you use the one that plugs in or do you use your phone?
I use my phone.
You use your phone. So it calculates, and if you guys don't know what it is, so it calculates it uses different metrics to say how good of a driver you are, essentially. You know, are you driving late at night? Is there a lot of hard braking? Is there excessive, high rate of speeds? Things like that. And what they'll do is offer a 5 or 10% discount up front, and then they'll adjust it as the app gives them information of what kind of driver you are.
I think I'll pay the extra 5%.
Yeah, and it's, again, a lot of people say, no way, I don't want them to know anything about what I'm doing, where I'm going. Yeah.
Do they pass that on to other insurers?
What's that?
Do they pass the information that they glean from you
No,
to other insurers?
no. That,
Not as far as we know.
yeah.
How's that? All right, so if you take nothing else away from this part of the discussion, remember this: conversion coverage. Conversion coverage. And I always tell everybody who will listen, get as much as you can, because you never know who's coming around that next corner.
Yeah, and just one more quick thing before you go on to the next slide.
Yep.
So if you look at these 3 vehicles, just one thing I wanted to note, you can see vehicle 2 doesn't have any prices in there for those coverages. So what that means is that this car doesn't have these coverages. So you could say, oh, I have 500,000 and my 1976 BMW is listed on my policy, but in actuality, the only thing this has is comp or other than collision coverage, because it's been taken off the road. It's sitting in a garage somewhere. So just to note, if you're ever looking through your policy and you notice there's no prices next to your coverages, it's because you don't have coverage.
So it sounds like you're recommending, look at your coverage, make sure it's adequate for your needs. You have rules of thumb that you give to people saying, for Connecticut, a driver really ought to have this amount, or really individually specific, based on what car you're driving, et cetera.
I don't know if you want to take that.
No, I mean, we always recommend the most that you are comfortable with and the most that you can afford. Like we said, to increase to the higher limits, it's not a huge increase over those lower limits. Like for example, at Kerr Agency even, we don't sell anything less than 100,000, 300,000, because honestly, it's not, the risk reward isn't there, because if there is an accident, there's going to be problems.
A lot of people jump up to the 255.
Yeah. Typically the lowest is 250, 500, and then they also have the combined single limit options that you can go to. Different carriers have slightly different options, but most of these are going to be all pretty universal. Your liability, your uninsured, and your comp and collision. And then down here is where it kind of gets a little unique with the packages and products that they include with those policies.
Yes.
So what happens if you don't have enough coverage? You get in an accident and you don't have enough. Do people go after you personally?
Sure, absolutely. And that's why, I say you want to get the higher limits, and one thing I said earlier was you want to get enough coverage in terms of liability coverage that a carrier will write an umbrella policy for you. Because as Craig said earlier, if you're looking at a $1 million umbrella that kind of sits as the next layer above your auto policy and your homeowner's policy, you're typically looking at around $200 a year. That's a lot of coverage for not a ton of money. And it gives you a lot of peace of mind, because once if you're in that catastrophic car accident, once your coverage is exhausted, if you don't have an umbrella, if you have a house, they're coming after your house. If you have a job, they're attaching your wages. If you consider yourself judgment-proof, I don't own a house, I don't have much assets, they can't chase after me. Well, in Connecticut, if they get a judgment against you, that judgment is good for 20 years. And when that 20 years is about to expire, they can file an application with the court to renew it for another 20 years. So if you have insufficient coverage, something goes haywire, and someone sues you and gets a judgment against you, that could potentially be hanging over your head for 40 years. Not a lot of fun. What we thought we'd do is just go through the basics. Now, everybody knows your homeowner's policy. Who here owns a home? Okay. The gold standard, not gold standard, but the standard policy for a single family home is what's called an HO3. There's a company that, it's called the Insurance Services Organization, that writes the basic policies that most carriers either use entirely or use as templates. HO3 is the standard single family home policy, and it has really 4 basic coverages that we're going to go over. Number 1 is, coverage A is the structure itself, the house. And Craig, what do you recommend to people in terms of selecting an amount of coverage for their house?
Yeah, so the house is a little tougher because it is a property limit, right? You're trying to figure out what it's going to cost you to rebuild that house, like, kind, and quality, if something were to happen to it. We use different metrics and programs that allow us to pull assessor information from town offices and build off of that based on square footage, modern building codes, and modern building rates. So depending, you can modify them and say, all right, it's a custom kitchen, it's 2,500 square feet, it's got X, Y, and Z included, it's going to need new electrical, and we can build that number. Right now, we see somewhere in the $185 to $200 per square foot when you're rebuilding a house. Also, in that coverage A is debris removal. So if your house is damaged in a fire, the town, again, 50% is usually the number. If 50% of the house is destroyed, the town is either going to make you take it completely down, haul everything out, and then rebuild it from there, or they're going to allow you to take out all the burned portions and go from there. So that coverage A is cost to rebuild as well as cost to clean up after an incident. The B, which, again, other than your liability on a homeowner's policy, everything is based off of this A in just about every carrier that I know of. They'll take your A, say it's $500,000, and they'll give you a percentage for B, which is outbuildings or anything else on the property. Your personal property would, usually it's 75% of your A they give you for everything that's not permanently attached to the home. And then your D is your loss of use, which in the event of that catastrophic claim where you can't live in the house, they put you in a hotel until it's fixed.
Now, in terms of coverage A, the coverage on the house itself, the structural coverage, a lot of people just assume, well, you know, the assessor says my house is worth $300,000, so I need $300,000 coverage. Wrong. And I think I don't want to use the wrong terminology here, but some lesser agents might use those same numbers. But the problem there, and Craig already said it, is what you're concerned with is the cost to rebuild the house. And especially, you know, in this market with some older houses, maybe you bought the house for $300,000. Maybe if that house was wiped out and rebuilt exactly as it is, it would cost $500,000 or $600,000. And we see that a lot. And not only is it important to make sure that you've got the adequate coverage to rebuild the house in the event that something catastrophic happens, but those numbers are important for, and you may have heard this term, who here has heard the term guaranteed replacement cost? Yeah? Okay. Well, it's a good and smart thing to buy guaranteed replacement cost, and just by the term, we naturally assume that what? Guarantees we're going to get replacement cost. What does it not do? It doesn't guarantee you're going to get replacement cost. Because if you don't have sufficient coverage, and this is baked into your policy that I know you're all going to run home and pour a glass of wine and spend 2 hours reading because it's so exciting, there is something in there called
Co-insurance.
co-insurance. And the co-insurance clause in your policy, if you have replacement cost, it's usually 80%, right?
Yep.
It says you have to, that coverage A number has to be at least 80% of the cost to rebuild the house. If you don't have at least that 80% amount of coverage, then you're going to get penalized when they pay a claim. So what they'll do is, just to try to use some simple math, I was not a math major, if your coverage A amount is $400,000 and it should be $600,000, well, you've got less than that 80%. You've got 66.66%. So if you have a big loss, let's say you have a fire and it severely damages the house but it doesn't destroy it, you got $100,000 in coverage, or you've got $100,000 in damage, well, you think, I've got plenty of coverage, right? And it's guaranteed replacement cost. What's going to happen?
So they take the percentage that you did insure it to, and they take that off of whatever the total amount to fix it would be. So if you're at 66% and there's 100,000 in damage, they're going to give you the 66.
So if your total coverage is, say it's $340,000
Right.
for the
Yep.
house, then they're paying you 80% of that.
Now, if your coverage A number is, say, 340, but that 340 isn't at least 80% of what it would cost to rebuild the house, then they're only going to pay you a percentage of your loss.
Yeah. It's a way for them to incentivize you to insure it to value, right? Because a lot of the price baked into a homeowner's policy is that property amount. So instead of saying, oh, well, I think 400,000 is enough, and decreasing your price, it incentivizes you to actually insure it to value.
Instead of
Right.
saying, well, the market value of the house is $250 and you insure it for $340, that's not it. It's going
No.
to be based on what it's going to cost
To rebuild it.
that house.
Yeah.
Bingo. Yes.
Who's responsible for coming up with the value or the rebuilding price? I know that
Fantastic question.
would come by
Fan-
and
fantastic
look at the
question.
house and see what other buildings you have, and then they come up with a price in the policy. I mean,
Great.
Should that be, or should you?
Great question.
Person.
Great question.
Yeah.
And I'm going to give you a stock lawyer answer. It depends.
Say that again?
It depends. Okay? Because there are a bunch of cases out there on that exact issue where, the homeowner thinks they're doing the right thing, they go to their agent, and the agent is typically the one that will propose the coverage A number. And Craig mentioned it earlier. Now you folks work with a bunch of different carriers.
Yep.
And the carriers, my understanding, jump in here, is that most of them have their own little calculations as to how they come up with what coverage A should be. And just from my own experience as a consumer, if you shop around to a bunch of different carriers, you ask for quotes from 10 different carriers, you're probably going to get 10 different numbers. They may be close, but they're not going to be the same.
Yeah.
They all have their different calculations in their programs, and they take things into account, like Craig mentioned, like they get, a lot of them pull the data about the house, the number of rooms, the square footage, things like that, from the assessor's cards. Some will go send people out to actually look at the house. Right?
Every policy, somebody will at least go to the house and look from the outside. Depending on the value of the house, they'll request an interior inspection as well.
Right.
And then they'll build, the inspectors build whatever number they think. And in our case, they come back to us and say, okay, this is insured to 97%, 92%. It's overinsured. What do you want to do? And they'll allow us to adjust it from there.
So in my view, as a litigator, I think that the onus should be on the agent to make sure that is done and done correctly. And I think, quality agents, they do that. Some of your not so quality agents that are just quoting price and trying to get the policy placed, they might not do that. And that's where you have to kind of resist the temptation to shop price. Price is important, but if you're not getting the coverage you need, it becomes a little less important in the event of a catastrophe.
Yeah, and what we would do is we would then go back to the underwriters and kind of put it back on the insurance company and say, we have this at $350,000, you're comfortable with it. If something goes wrong, that's where it is.
You say to them, we got this at 350,000, is this going to be 80% of it? Do you say to the insurance company, you get a guarantee from them that the number that you're insuring is 80% of it?
Yeah, as long as there's some paper trail, and they can't. If we insure it to 350,000 today and it burns tomorrow, and then they say, oh, really, it was 550 and you're underinsured, it would be a negotiation, and that's when we.
That's when I come in.
Yeah. So and
We don't want to give you work, but
I'm the cleaner. I come in to clean up messes. All right, so are we all good on coverage A and B?
Is there a rule of thumb? Should you be 50% over what your original cost is, or is it?
Well, see, original cost that's going to be different in every situation because
50% above current value?
no, honestly, the market value has nothing to do with your coverage.
throw it out the window.
Yeah, it's doesn't even factor in. It's really about square footage and current building costs. And like he mentioned, guaranteed replacement cost. We've seen it go a little bit by the wayside in terms of coverages. A lot of times what they'll do now is offer 150% on top of A or something like that as part of the coverage instead of just guaranteeing it. So it can be 50% over that A.
And typically when you have guaranteed replacement cost, it's going to be dwelling and contents. So let's say you have that fire and you have the damage to the structure and you lose a bunch of contents. They don't pay you that replacement cost full value of the claim up front. What they'll do is they'll depreciate it down to what they call actual cash value, which is present value of either the structure or the contents. So they'll actually pay you a percentage. Typically, it ends up being somewhere around 70 to 80% or so of the loss until you actually get the repairs done and then replace the things that were lost. And then it's called holdback. And then you apply for the holdback to get the rest of it back.
And does it work that if there is a fire and, say someone's getting burned, you got to replace it, do you have to come up with the money first, or does the insurance company?
They will typically advance a portion of the loss. They're obligated, once they agree that there's coverage and that the claim is worth at least X, they're obligated to pay you X. Okay. Even if you're still far apart on the total value of the claim, once they acknowledge that let's say you have that fire and you hire a contractor to do an estimate and he says, oh, this is $300,000 worth of damage. But the company has their own guy come in and he says, no, it's only $50,000 worth of damage. Well, you're really far apart, and that's going to be a process to get to an agreement. But they've acknowledged that they owe at least $50,000. Now they have the obligation to pay at least that. Okay? All right? Yeah.
So what if you make improvements to your house, like you update your kitchen, for example? Should you be notifying your agent?
Yes, yes, and yes.
Yep.
And that's another thing. People just ask me, well, do I really have to tell them about? Yes, absolutely. You have to tell your company or your agent about anything that is important from an underwriting perspective.
And do you tell them the kind of the material that's used?
You certainly could. What we tell everybody to do is just walk around your house with your phone out and take a video of any.
Or a picture, or as a
Sure.
Yeah, or
Pictures are
picture,
fine.
anything that you can say. This is what I had. If this is what it was, they can't. It's tough to dispute a picture or a video.
Right. But in terms of anything that might impact the nature of the risk or the pricing, like you remodel your kitchen or what have you, yes, you should absolutely tell them because that impacts the underwriting. And what can happen, and I've seen this happen, people get trampolines. You stick a trampoline in the backyard for the kids. They don't tell their agent. They don't tell their company. Somebody gets hurt on a trampoline, brings a claim. Best case scenario, not covered. Worst case scenario, they're going to void the policy. You lied in the application. That's a material misrepresentation. That's a concealed, you concealed a material fact. We're voiding the policy. I've seen that with dogs. I've seen that with trampolines. Somebody puts in a pool. Things that add risk and you don't tell the carrier about it, that opens the door to them potentially voiding your coverage altogether. And if there's a claim, they can deny the claim, and you're on your own.
And it can also go the other way. If there's a security system installed, you can let them know, and they'd be...
Get a discount.
Yeah.
Yeah.
My little trampoline that I exercise on, is that in the same league?
You're probably okay on that. I wouldn't let the neighbor's kid on it, however. But that's just me. All right. So, do you want to cover personal? We touched on personal property. Yeah. Sure.
We have an in-ground pool in the backyard.
Yeah.
She was just telling me, the policy calls it another structure.
Outside structure.
Outside structure.
Sure.
That name what it is? Or no?
It would be covered under that other structure's
Yeah.
coverage, and that's going to be usually a separate limit. That's usually what, like 20% of coverage A?
Yeah, somewhere around there. If you go to the next
Yeah.
page, you can see it.
Oh, okay. Well, here we go. Yep. Here's a homeowner's declaration page.
Yeah, so it's actually 10% in this particular policy. So coverage A, 859,000, 85,000 for other structures. So that would fall if you have a shed with the pump and all that sort of things. That would fall under that sublimit.
Oh, that's a good point. So,
Put in a irrigation system, if underground for the water.
Yep.
Should that?
that should be covered under other
That would be
structures
covered
also.
under that. It'd be anything permanently attached.
Yep.
We like to say. So
Permanently installed.
yeah.
Yep. But I'm glad Craig mentioned sublimits. That's another topic I wanted to touch upon. I have an exemplar policy here. Once again, while you're sitting around at home enjoying a glass of wine and reading your favorite insurance policy, one thing you might notice is there are special limits of liability. And what it does is it sets forth categories of things that there are separate limits on. For instance, just in this policy, $200 on cash. So if you have a theft or a fire loss and you go to your insurance company and say, well, I had the safe in my closet with 10 grand in it. I'll say, great, here's $200. The biggest one that I tell people to be very conscious of is every standard homeowner's policy is going to have a sublimit for jewelry. And it's not a lot of money. Sometimes it's $500, sometimes it's $1,500, but it's not a ton. And if you've got that nice engagement ring or maybe your grandmother's diamond necklace, what have you, you can blow through that like that. So
In scheduling that property, it brings the coverage to anywhere in the world. So if that ring is lost when you're out somewhere, you're okay, as long as it's scheduled.
And you have to, what you need to do, anything of unusual value, antiques, artwork, jewelry, anything like that, you want to get appraised, and you want to give those appraisals to your agent and have them shop that coverage. Because I don't remember the numbers, you can probably give them exemplar numbers, but it's not a whole lot for that extra coverage, and it gives you peace of mind. If you've got that $20,000 value engagement ring and you're on vacation in Puerto Rico or something and it slips off your finger in the surf and it's gone forever, do you want the $20,000 or do you want the $1,500 limit in the standard form policy? So.
And it does go for unique things too. Like I have my golf clubs scheduled because they were stolen a few years ago and replacing them hurt. So It's not just jewelry and antiques.
This one must be some golf clubs.
Well, after the car went, they were in there with them.
Okay, anything else on?
So
Homeowners?
on the last piece is this right here, this section E, personal liability. So again, same as your car has liability, your homeowner's policy has liability. This would be anything that happens at your house. He had mentioned a dog bite, or somebody slips and falls as they're delivering a package. Anything that you could be held liable for.
It's
covers.
not necessarily just at your house. It covers your personal liability. You make a mistake, you do something stupid out there in the world that doesn't involve operating a car or anything having to do with your business, and someone brings a claim against you, you're covered.
Yep.
You'll be provided a defense, and if you're found responsible for a negligent act that results in bodily injury or property damage to somebody else, you've got coverage for that. And that is the main reason why I try to impress upon younger people, college kids fresh out of college. Maybe they don't own a house, they don't own a condo, they're still scrapping to find that career job, and they're renting an apartment. I don't own anything. What do I need a renter's policy for? Which, is that an HO6?
Yeah.
I still got it. What's going to cover whatever stuff they do have. Maybe it's just a futon and an Xbox and some clothes. But more importantly, it's going to cover them for personal liability. And I've seen cases like this. I had a client, a nursing student. She was about a year out of college. This is about 5 years ago. She and her boyfriend were renting an apartment. Somebody left a cigarette burning in an ashtray. You know what happens next? There's a fire. And I don't remember the damage. It was about $20,000, $30,000 worth of damage to this. They were living in a duplex, I think, in Torrington or something. So the landlord's insurance company paid for the damage, and then they came after her. She didn't have a renter's policy. She didn't have any liability coverage. And she's a young kid just getting started with her career. Paying the rent on a monthly basis was enough of a challenge, let alone trying to defend against a lawsuit. If you have, whether it's an HO3, you own a house, or a condo policy, or a renter's policy, you gotta have a homeowner's policy. Just for that, even if you don't own anything, just for that liability coverage. It can be a godsend. All good on that?
Yeah, any other questions on the homeowners?
Well, what about things that happen inside, you get a water leak or something like that? Does that kind of stuff covered? I know there was an issue a few years back. We had that big ice storm, and it was a lot of ice, and some things leaked in the house, and some people found out they weren't covered for it.
I wish I'd heard from those people. What you're talking about is ice damming, and that is typically going to be covered. And if it's not, that's when you should be calling your lawyer. Okay, and that's one other thing I wanted to touch on.
Or like pipes or something happens.
Right. Well, it's going to depend on the cause of the loss.
Right. If it's just something.
In your example, a pipe.
Wear and tear, and it was leaking anyway, and you didn't get it fixed, and something happened. But if there was nothing wrong with the pipe to begin with, and something.
Yeah, water is always a tough one because it really depends on where the water comes from. If it's a backup of the sewer or drains, it would be covered most of the time, and it's all of the ensuing damage that it does create. Say it ruins your walls and your floors, all of that would then all fall under that and be covered. If it's a flood, it would not be.
Right.
And one of the big things that happened down in southern Connecticut during the hurricanes was it a flood, or was it wind blew a hole in the side of the house and then water came in? Or was
Covered.
Covered.
I have a case right now, no joke. my client had a small collection of antique cars. He had 3 cars. And there was a flood. Now, this car policy, it was a specialized collector car policy. It did cover flood damage, but it didn't cover mold damage. Okay, mold was specifically excluded. So the insurance company, this is an all-time classic, the insurance company denied the claim, saying that these cars weren't ruined by the flood, they were ruined by the mold that grew in them after the flood was over. You can't make this stuff up. So, are we good on homeowners?
Yeah.
Okay. Yes.
When an insurance company is determining whether they're going to cover something or not, does it matter if the homeowner caused the problem or just the damage?
If you cause the problem by mistake, generally speaking, you're fine. Intentional.
Stupidity is covered.
Yes.
That they say.
Actually, stupidity is the primary reason insurance exists in the first place, quite frankly.
So, as an example, one time I turned on my sink to fill it with water and forgot for a very long time. And it flooded my kitchen, went down into the basement. And I mean, I just took care of it.
Yep.
But what if it needed to be replaced? That's something I could call.
Covered.
Yeah, we
Covered.
My parents had one where we had a neighbor watering the plants while we were on vacation, and he left the spigot on outside, and it filled the basement because it ran for 7 or 8 days while we were out of town, and there was a few feet of water in the basement.
Wow.
Was it covered?
Yeah. As long as you don't intentionally destroy your things.
Yes, every insurance policy ever drafted since the beginning of time has an intentional act exclusion.
Right.
So, we weren't intending to really get into claims processes too much, but I just wanted to give you a couple of things to be aware of if you do have a homeowner's claim. First of all, I always tell people, don't just take the insurance company's word. If you have a property damage claim, something, a tree falls on your house, you have a fire, you have water damage, or whatever it is, get a contractor that hopefully you know and trust to take a look at it and give you an estimate. And that'll give you a good marker to gauge the insurance company's assessment against. Because they're going to send out their own person who's going to write it up. And I'm not saying this happens all the time, but quite often the number that the insurance company will come in with to start is not what it's really going to cost to fix what's wrong. And I just wanted to point out a couple of other things to be aware of if you have a claim. Reservation of rights letters. Typically, they're about 7 or 8 pages long, and they quote a whole bunch of stuff from your policy. They say, "Dear Mr. and Mrs. Smith, we understand you had this insert type of loss here, fire loss, tree fell in your house, whatever. We're investigating the claim. Here's a bunch of stuff from your policy," and then they explain how there's potential that this might not be covered, but we're going to continue to investigate. That's a reservation of rights letter. That's a red flag that somebody is looking at this claim as one that they may try to deny, okay? If you get a reservation of rights letter and then the company says, well, we've retained John Smith, an engineer from XYZ Consulting Company, to come in and inspect, that's 2 red flags up at once, in my experience.
Yeah, just to kind of piggyback on that, the different carriers operate differently when it comes to claims in terms of third-party assessors and third-party claims handling. Depending, it's certainly a question I would always ask whoever you're working with insurance, or if you're going direct to a carrier, ask them what they do. a lot of times a third party's job is to decrease the size of the claim.
Or eliminate it.
Yeah. Whereas if it's a carrier employee, they don't have that. They don't have the. Jesus, what's the word I'm looking for here?
If it's an in-house person, generally speaking, and this is very generally speaking, their job is to just write it up and submit it.
Yeah.
If it's an outside consultant, I say that's a red flag because quite often now you're dealing with someone whose business depends on getting more assignments from the company. So if I'm outside third-party consultant and this company is sending me files to write up, if I can write it up at $100,000 or I can write it up at zero, which is going to make my customer happier? See what I'm saying? And I'm not casting any aspersions on the industry as a whole, but part of what I do is I represent both sides of this equation, but some of the cases that I work on, I'm representing policyholders with denied claims. And what I have seen on occasion, and this is just on occasion, sometimes these third-party experts are brought in, we suspect, to come up with an excuse to deny the claim, and that way the carrier has plausible deniability. They can say, if it's later found to be an invalid denial of the claim, they can say, well, it's not our fault. We did the right thing. We hired an engineer. We brought in an expert, and we were relying on him. So there are examples of that out there. That's why I just mentioned that as a red flag to be aware of if you have a claim.
That happens.
Call a litigator that knows this stuff. And the third one I put up there was if you're advised not to file a claim or that there is no coverage, and I say by anyone other than the insurance company. And I say that because I've actually seen this, and you've probably heard the stories in your business, Craig. I have seen, again, very occasionally, a couple of not so great agents out there who, I just had this about 6 months ago. A client came to us saying, oh, we just got sued and we don't have any coverage. And I looked at the complaint. The complaint is the document that starts a lawsuit. And I said, this should absolutely be covered. 100% covered under your homeowner's policy. Oh, well, Susie at our agency said we shouldn't even file a claim because it would be a red flag to underwriting and our rates would go up and it's not covered anyway. And my response was, your agent said that? So I got on the phone to the agent and I gently persuaded them otherwise. The claim got submitted and it's covered. Now, Mr. Agent, can you think of a reason why a not so above board agent might not want their client to file a claim?
I absolutely could. Yeah. Losses are shown on our end to our carriers. Most of the time, if anybody ever tells you not to file a claim, I would file a claim. And what you can do is you can do a notice only claim and say, hey, I just want to put you on the radar, and this happened. I don't know if there's going to be anything that comes of it, but I want to just put you on notice. And because in this boilerplate, 50 pages of policy, there is a section in there. If you don't notify them of something in a certain amount of time, that's a reason for them to deny a claim. So if you come a year or two down the road and say, oh, this happened a year ago, they're going to say, well, you should have told us when it happened.
Right. So again, it's rare. I'm not casting any aspersions on Craig's profession as a whole, but occasionally you can run into an uncareful or possibly even unscrupulous agent who is going to advise you not to file a claim because they're protecting what's called their loss ratio.
Yep.
And agencies basically get graded by the insurance companies on what their loss ratio is. If you're selling policies to people that send a whole lot of claims that we have to pay, well, now we're not very happy with you.
Yeah,
right?
absolutely. And loss ratios are tough because it's the way that they can tell if we're writing quote unquote good business, or if it's severity or frequency of accidents. If there's severe accidents are going to happen, But if there's a lot of accidents, then it becomes a problem. But it's certainly not a reason to not file a claim.
So that kind of dovetails back to what I said earlier about how, if you have a property damage claim, for example, you should do everything you can to get your own estimate. So you have that, you have that marker to measure what the carrier says. And if the gap is just too big, you might need some extra help. There are lawyers that do this stuff. There are public adjusters. I don't know if anyone knows what that is, but there are insurance adjusters out there who are licensed specifically to represent the policyholder. And they kind of do the same thing as the company adjuster, just from the other side. And their job is to get you as much as possible for your claim. But the same thing, if anyone, even if it's the insurance company, if they deny coverage, don't take that denial at face value. There's quite often we see denials that are mistakes. We see denials that, in our view, are occasionally more intentional than mistakes. And I know a large part of my practice is taking those adverse decisions and trying to turn them around. And it can be done. And it happens more often than you'd think. So if you have a claim and the answer that you are getting, whether it be from the carrier or from your agent or anyone else involved in the process, is not what you expected or hoped to hear, elevate it to the next level. Go see someone who can explain it to you and walk you through the process, because there might be more out there. Anything else?
No. That's it. Was there anything?
Any other questions? All right. Well, that's basically, yeah.
Chief, back to the rule of thumb idea, what would you drop collision coverage on a vehicle?
I'm glad you mentioned that. I would say if you only drop collision coverage on the car if you're fine with not having it anymore. And if it's, I know some people used to have winter crashers. You have an old beat up car that isn't worth anything, you don't care about. If that car disappeared from the face of the planet tomorrow and it wouldn't bother you at all, and you would get nothing for it, fine, drop collision. But if it would hurt and you'd need to replace it, or you couldn't take the loss of that value, then you should probably have some collision. You can increase your deductible to reduce rates, right? Yep. If that's a concern. But I'll give you another personal experience. My father-in-law, it's about 2 years ago, brought his pickup. I don't have a pickup truck, and we were moving stuff around. He brought his pickup truck over for us to use one weekend, and I had it parked in front of my house. And this is a Saturday night. Some idiot comes flying down the street, and I don't know how you don't see a pickup truck parked right in front of somebody's house on the street, but she slammed into it and knocked it up across my yard and into my woods. Yeah, she was moving. Turns out, shocker, she was uninsured. And my father-in-law, unbeknownst to me, why bother asking your litigator son-in-law, but he had dropped collision coverage on his pickup truck because his agent told him he didn't need it, believe it or not. Because the pickup truck was about 8 or 9 years old, but it was still worth $8,000, $9,000, $10,000, big old pickup truck. Yeah. So he had zero coverage on it. But because he had loaned it to me for the weekend, I made a claim on my auto policy. as a temporary substitute auto. So that's one thing that we didn't talk about. You'll find in your auto policy there's a little clause buried in there that says, in addition to the cars listed on your declarations page, there's coverage for what's called temporary substitute autos. So if your car's in the shop and you have a loaner, if you are out of town and you get a rental car, it's temporary substitute autos. Because I had borrowed my father-in-law's pickup truck for the weekend to move some stuff around, it was a temporary substitute auto and they paid for it. Had I not been able to convince them to do that, he'd be without a pickup truck. So if it doesn't matter, then don't insure it. You need liability for it. But if it ceased to exist tomorrow and that would be a loss and that would be something you'd miss, then you probably want to look into it, at least, like I said, maybe higher deductibles if you're concerned about rates.
Does that drive a decision when I go to rent a car and I want to use my own insurance? I don't have any collision now, so I don't have any coverage unless I get the rental agent's coverage.
Yep. All right, anything else?
What about, if you look at all the agents that are out there, there's State Farm or also whatever, or an independent agent. Any guidance there? What direction a person would go? I mean, I assume an independent agency probably shops a regular collection of carriers.
Yeah, so I could only speak to what we do. So at Kerr Agency, we have approximately 25 carriers that represent our personal lines side. So each carrier, depending on their product that they're offering, is going to be unique in the type of client that they're looking for, as well as where they're going to be competitive. For example, Hartford they have their AARP program, which so obviously it's built for elderlies. That's what it is. That's kind of their bread and butter. Where other carriers are better with teenage drivers or multiple cars or so on and so forth. So that's where kind of the ability to shop it is an advantage for us. Because depending on who the actual client is, we can find something to tailor the policy to their needs.
As an example, a couple of years ago, I went with an independent agent. And from 2 years ago till now, my policy is due this month. My price has gone up 24% over what I paid 2 years ago. So I'm averaging about 12% a year. I thought that was kind of high. And I would hope that my agent would be kind of going to bat for me. Is there an automatic re-quoting when you get into a new year, or is that just, do you wait for the customer?
Depends on the agency. Again, I don't know what carrier you're with. Over the last 10 years or so, auto prices have skyrocketed.
Different. What I expect, maybe 3% a year to go up or something.
Yeah, it varies.
12 does seem high, and it really does depend on the carrier, how they're doing in the state. If they have exceptionally high losses and they're running at a 125% loss ratio, which would be their fixed cost plus their losses, they increase their rates. So they file rates with the state of Connecticut, they increase them, and then pretty much across the board of their whole book of business, they're all going up.
And that's the carriers, not the agents.
The carriers. Now, what we do to combat that is re-quote it. And we usually get policies in from carriers 45 to 60 days prior to renewal. And if it's, we expect inflationary increases, 3-4%. But if it's more than that, we quote. And there are tools we use that make it pretty easy to do it pretty quickly. We can quote all of our carriers at the same time.
Yeah, but it's like anything else that we shop for, right? You want to make sure that you're doing your homework and finding the best deal, not necessarily the best price, but the best deal. And you want to educate yourself as to what you need. And one difference between, say, an independent agent like Craig or I think you mentioned State Farm and Allstate. You go to a State Farm agent, they're going to quote you from one carrier. and get a quote from them. But then you go to a guy like Craig, and he can quote you from 20 carriers. So it's just, it's how much diversity in your options do you want to look at? And obviously, you know, the more the merrier. If you can quote apples to apples, if you can say, here's what I need, what do we need? What does everybody need? Conversion coverage, thank you. And maybe the levels of coverage that you're looking for, and you get multiple quotes from a couple of independent guys, maybe you know, maybe the Allstates and the State Farms, then you really know what you're looking at and you know what your options are. Right?
Is it common at all for people that say that their car insurance one place, their home another place, or do you see most of them combined?
Most are combined, just because the package savings that they offer is usually too good to split it up.
Right. You'll usually get a premium discount.
It still wouldn't make sense.
Yeah. Yeah. Unless, say, you had a home on the shoreline that your carrier doesn't work within, you know, some say if it's within 5 miles of the shore, we're not doing it. So that's a situation where you'd go to a specialized policy for.
And there's some, like on the homeowner side, there's some carriers that just, they won't insure you if you have a trampoline.
Yeah.
They won't insure you if you have a certain breed of dog. But generally speaking, most carriers do offer pretty good premium discounts if you have your homeowners in your car with them. Yeah. All right?
Funding for Simsbury Community Television is provided in part by contributions from viewers like you. Thank you.